On the world of business now, global financial markets are buzzing with anticipation in 2024. Investors seem convinced that major Western central banks are poised for a significant shift.
In fact, transitioning from raising interest rates to potentially cutting them, and despite cautious warnings from central bankers, recent weeks have witnessed a surge in global stocks and a decline in top government bond yields. And the market's conviction stems from the surprising resilience of the US economy, which was fueled in part by consumers' pandemic savings and the country's allure as a safe investment haven. The optimism is palpable. Investors are betting on the Federal Reserve potentially cutting rates by up to 1.5% by the end of 2024. However, even with this anticipated cut, policy rates would still hover around 4%, a level that has not been seen for most of the past 2 decades.
And this poses a unique challenge, as monetary policy at this level could potentially act as a drag on growth. Adding to the complexity are various geopolitical tensions, global conflicts, and upcoming elections that could reshape the world order unexpectedly. While investors anticipate a shift in central bank policies, the world is yet to complete the transition from an era of cheap money to one where it is not as readily available. And as we move through 2024, the effects of this transition are becoming more apparent. Companies and even entire countries may need to restructure their debt liabilities, grappling with the challenge of affording high rate cuts.
Now, emerging market debt negotiations and rising corporate bankruptcies are already quite visible signs, and sectors such as commercial real estate, particularly those affected by post-pandemic changes in work culture, are expected to face challenges. And for consumers, in fact, higher savings yields come with adjustment of accommodating higher borrowing costs.